answering any questions that you may have about this deal. So 6:04, just waiting for 6:05, and we'll get started. The rest of the folks can join us. So the real purpose of this is really just to go over the presentation deck that you already hopefully have had a chance to review. In case you've not had a chance to review it, I guess this will be the first time you'll see it. With this presentation, we're going to try to speed through it somewhat so that we can really leave a lot of times for questions. Because I do believe that the most value typically is when there are when we are answering the questions, because it's, you know, you can always read the slides, but the questions really shed a lot of light on some of the intricacies of this deal. So I think that's 6:05. So why don't we get started? Yeah, well, everybody, welcome to the second webinar for the Bank Lofts apartment. I'm Dr. Julius Oni, CEO and co-founder at XSITE Capital, and co-hosting with me today the three members of the XSITE team. We have our co-founder and director of acquisitions, Mr. Tenny Tolufari, and our co-founder and director of operations, Mr. Leslie Awesome. And we have Braden Hayde, who supports on the back end, and it's a very fantastic member of the team. The Bank Lofts, before we even get into this presentation, we obviously that's the table of contents there. And that's just a beautiful picture of the building there with the pool on the side. So just to kind of give you a feel of what this looks like in the fall. This is the entrance to the building. You can tell it's an old bank that was converted into apartments. And that entrance you see must stay, because that entrance, that green entrance, is one of the reasons why we're getting historical tax credits on this particular property. So this just a few pictures just showing the insides of this building. It's the classic luxury apartment in downtown, in its downtown southern state. So this is a 113 unit property located right in the business and entertainment district of Columbia, South Carolina. And if you don't know, that is the capital of South Carolina, which is a fast growing state. Our lawyers they don't force us, but they recommend that we share with you this disclaimer. And literally what it just says is that, this is for educational purposes only. And that, we as XSITE Capital do not provide tax, legal, or investment advice. And you should definitely do your due diligence and confirm a lot of the things that we're going to share with you in this presentation. We've done our due diligence. We know this is to be very true, but you need to do your due diligence to talk to your CPA, talk to your lawyers, talk to your financial advisors, make sure this is a good fit for your portfolio. If you do, then feel free to join us on the ownership group of this property. So the executive summary, this is just a nice little summary of, the story, the history of this building. Just like I told you earlier, it was a bank that was built in, starting from the 1920s to the 1930s. But in 2016, it was converted into apartments. So it literally was rebuilt. Everything besides the structure of the building was rejigged and converted into apartments. So it's a Class A property based on that. And next. So this is just a little investment summary. This is a slide you're going to see coming up pretty frequently in this presentation. And this is just to kind of let you know that we are purchasing this property at a 5% cap rate. Hopefully you know what that is. If not, we'll be more than happy to explain it to you. At a DSCR of 1.5 in year one, and an average DSCR, which is the debt service coverage ratio, meaning we can, a DSCR of 1 means that you can actually, the cash flow from the property can only just pay for 100% of your loans on the property. A DSCR of 1.5 means after paying for your loans, you're still going to have a whole lot more cash, about 50% more cash to play with, if that makes any sense to you. And then the hold period is going to be 7 years. We are raising $5.75 million for this property, and we are projecting an internal rate of return of 15 to 18%, an average annual return, which is a metric that most of you are familiar with, of 19 to 25% per year on this property, and an equity multiple of 2.3x to 2.7x on this property. And we are happy to announce that of the equity that we need to raise, we are already at about 80% commitment on the property, and we only just made this property public only about a little over 2 weeks ago. So this is one that is going to fill up quickly. Obviously, committing does not guarantee you a spot. It reserves your spot, but whoever sends the money in fastest actually gets a spot on the ownership group of this property. Property benefits. Just to kind of give you a feel for some of the amenities in this property, they're upscale kitchens with stainless steel appliances. There's a beautiful pool that we're going to make even more beautiful, because it's beautiful for 2016 standards right now, but we're going to bring it to the 2020s. And there's a nice little entrance with an entry and package acceptance area, but we're actually going to make that even better by putting in some Amazon lockers. And I'm already leapfrogging some of this presentation, but we'll show you what that would look like later. So the location is amazing, period. It's located literally a few steps away from the state capitol. It's located a few steps away from all the nice bars and restaurants and all the fancy fun places that people would want to like spend time in Columbia, South Carolina. It's located just 7 blocks away from a 1.3 billion development that was just that's being worked on right now, that has like a baseball stadium and a mixed use development around it, and that is bringing in a whole lot of economic activity into that area. Just recently, Nephron Pharmaceutical expanded in Columbia, South Carolina. $300 million they invested, creating about 380 new jobs. Same with the owners of Mike Hart's Lemonade. They built a $400 million production and distribution facilities, creating 300 new jobs. And those are just a few of the multiple employers taking advantage of the business-friendly environment of this fantastic city. So next. This hospital is literally across the street from Prisma Health, which is one of the biggest hospital systems in Columbia, South Carolina. A good number of our employees are actually employees of that hospital. So the tenant mix in the building is exactly what you would want. These are people who have jobs that are resilient to economic downturns, that are resilient to any type of problems in the market. So you're going to actually see the breakdown of the employment of the tenants in the building very shortly, and we'll be able to show that to you. But the most important thing is Prisma Health, University of South Carolina, Medical University of South Carolina is only just a few minutes away, and there are 3 major hospital systems close by, and so we are positioned beautifully to take advantage of those great employees that want good quality places to live. So this is the breakdown of the people in the property currently, and it's important to note that the average annual income of an household in this property is $113,000. $1,000 per year. That is unusual. That is not typical for this market. Our property that we bought in April 2021, just down about 12 minutes away from this particular property, our average annual, household income on that was in the it was the mid 50s, $1,000, and we are doing fantastic on that. So when you have an average annual average household income of $113,000, that means those people are going to be way more resilient to any changes in the market. You know, when their rent goes up by $100, they are less likely to move out or want to change. And granted, they want some good quality and significant value in exchange for living there, but that's exactly what we bring to bear as XSITE Capital. Healthcare professionals, banking and services, financial services professionals, education professionals, graduate students from University of South Carolina kind of comprises the majority of the folks that live in this building. So we are buying it for $17.45 million. It's 113 units, like we said earlier. It's sitting on 2.2 acres. And just a little bit about Colombia's population, 843 and growing. It's actually projected, Colombia is projected to grow about 43% over the next decade. By 2030, Colombia is projected to be 43% higher in population. With that comes significant jobs. With that, and because those people are moving for jobs that are being created in Colombia, in the Colombia metro statistical area. And with that comes increase in rent growth. And the combination of all these things makes this a perfect place to be investing at this time. Next. Oh, and the previous slide, I forgot to highlight that we are 99% occupied in the building currently. That has been the case since early November. That has not changed since we started to be interested in this property, and we don't expect that to change much and usually, just for those that don't know, when the property is 99% occupied, what that tells you is that the rents that the property is generating is most likely under market rents, and that will be proved later in this presentation. Because typically, as multifamily operators, we like to keep the occupancy rate somewhere around 95%, because and we constantly test in the market to see what the market rates are. But you know, when it's 99%, that means there's a lot of opportunity to probably bump the rents a little bit to actually get the appropriate occupancy rate, the ideal occupancy rate. Community amenities, they're listed right there. There's a business center, a pool, fantastic balconies. Some of the properties even still have safes in them that are great conversation starters. They have high ceilings, high-end interior finishes. The tenants have parking, 145 spots to divvy up between them. There are a lot of dead spaces also in the property that we're actually going to be converting into storage for the tenants. So thereby adding additional value to them. So there are great opportunities in this property. This is the unit mix. We have a bunch of 1 bedrooms, some 2 bedrooms, and some studios. This is perfect for like the young, forward-looking person who is trying to live in downtown, who loves downtown living. I think somebody was, Grant, I see your questions coming in. We'll answer all those questions real shortly. Thank you so much. Keep those questions coming in the chat, by the way. 646 square foot is the average square footage of this. Pretty classic for a downtown apartment. So the business plan. So to add significant value to this property so that we can increase the net operating income of the property, which means we increasing the revenues, either from rent, from increasing the rent or generating some revenue from renting, the rooftop to AT&T for a 5G tower, or things like renting out a co-working space to folks to generate some additional income. And then we're going to decrease the expenses. By doing that, by decreasing the expenses, increasing the revenue, we increase the net operating income, which in turn increases significantly the value of the property. In a 5 cap market, if you increase the revenue of that property by $1, you increase the value of the property by $20. So 20x return on that investment. So these are businesses that we're buying. We're literally optimizing the businesses and thereby increasing the value of those businesses. But how do we add value to this? We're going to put in a dog park. We're going to put in a dog wash station. We're going to do some plumbing retrofit so that we can be responsible, save some water, be responsible to the environment, but also conserve on the water that is being used by the tenants and prevent wastage in that sense. We're going to renovate the pool house, like I said earlier, bring it from 2016 to 2022. We're going to put in some Amazon lockers, make this a very comfortable, easy place for people to get their packages nice and easy when they live there. And on the interior, since this was just built in 2016, there's really not much else to add. So all we're going to do is just do some smart home upgrades. And we're going to show you what that looks like on the next slide, and add some storage spaces into those dead spaces in the building that we spoke about earlier. And also there's one of the elevators that's down. We're going to repair or replace that. And we already have money here marked for that. So in total, we have a total value add cost of about $700,000. Next. So this is just an illustration of what the smart apartment upgrades are going to look like. Yeah, you could kind of read that and check it out. We bring in this property into the 2020s. Next. Co-working space. So, I mean, nowadays with COVID, we all know how important it is to have a very comfortable place to work from, particularly if you have if you just in your apartment. Sometimes you may just want to have another space in the building where you can go do some work, where there are going to be some business center type of amenities to help support your business or your work or your office. And so we're going to redo the co-working space, and I mean, like, rejig a co-working space that people can actually maybe rent a desk, rent a space, rent a corner, throughout their time as tenants there. And we think this is going to be a great value add for the tenants. So our primary business plan is to hold this property for 7 years and sell at year 7. At that point, we are projecting that you, as the investor, would have made between 19 to 25% average annual returns, depending on the market conditions. And that translates to about 2.3x to 2.7x equity multiples. And this is based on the most conservative underwriting, because that we pride ourselves at XSITE Capital on underwriting as conservatively as possible, because the market cannot always continue to be super hot. So we're actually projecting in our underwriting that the interest rates are going to be going up, that the cap rates are going to hopefully and most likely be following the interest rates up, which means that the market conditions are most likely going to be different at that time when we're planning to sell. And if that is true, if we are correct, we still projecting that you're going to make a significant profit on your investment on this deal. If we are wrong and the market is just as hot as it is today, 7 years from now, then this is going to be one of those unicorns, and we all going to be smiling to the bank, unbelievably. The secondary business plan, however, depending on what the market conditions are, is to refinance in year 7, return at least 100% of the capital back to the investors. This is after you've been getting cash flow for the past 7 years, meaning for every year that you would have invested, you would have gotten at least 7% preferred returns. in cash flow. So if you invested 100K, you would have gotten 7,000 for 7 years, which is $49,000. Then you get your $100,000 back at the refinance point, at least $100,000 back. If we are able to do more, we do more and give you even more back. And then at that point, we keep you in the deal still long term until you get those returns that we promised you. Meaning, so this is actually a fantastic page here. It kind of shows you, I want you to kind of pay attention to the right side, the capital stack, which just says that the debt to the mortgage, to the lender is going to be number one on the capital stack. You got to pay the bank first, right? The next people, and the people who own 70% of this deal are the limited partners, the equity partners, people who are bringing money to the deal, and they get paid next. Only and if only you've achieved your returns, do the GP, the general partners, that's XSITE Capital, and our partners who are actively sourcing these deals, putting it together, implementing the business plan, managing the property managers, we're interfacing with the lawyers, the accountants, all the professionals that are asked to put a deal of this size together. Those people split the 30%. But once again, the LP, the limited partners, are right next to the bank when it comes to the capital stack. I want you to now look on the left side of the screen. That's the exit, where it says XSITE partnership structure. The preferred return is 7%. Just like I said, you invest 100K, you get $7,000 at least. If we have more cash flow, you get more, but at least you get $7,000 in cash flow on a yearly basis, divided into quarterly payments over the year for the length of the time that we owe this property. And the equity split after that is after you've gotten your 7%, then we split any extra cash flow 70-30%, 70 to 30. And if at some point we get you an average annual return of 22% average annual returns per year on your equity invested, the equity split then goes down to 50-50. This is pretty standard waterfall in the industry. This aligns us with you in the sense that if we are able to give you at least 22% average annual returns, we should be able to be rewarded a little better for being such great stewards of your investment. The target return summary, average annual return, 19% is what we're projecting. Internal rate of return, 15.1%. We can talk about that if some people don't know exactly what that is. Equity multiple, 2.3 to 2.7%. Average cash on cash, 7.6%. That's that preferred return plus whatever is on top of that extra. Excellent. Next, rent comps. So this is just looking at the other properties in the area that could be somewhat comparable to this. Not too many properties have the same vintage as this property, as you can imagine. This was a bank that was converted to apartments. So most of these other apartments are like ground up developments and things of that nature. So, it's kind of hard to find a comparable property really. But this is some things, some of the properties in the area that you would consider potential comparisons. If you notice, most of them are like 98 to 100% occupied. There is incredible demand for apartments in this particular area. Our property that's 12 minutes away, also 99% occupied. We can't get people out fast enough because we're trying to do renovations and it's so hard to do it. So the demand certainly outweighs the supply in this market, and it makes it a really good place to be. So when you look at the rent comps there, you have land bank at total average of about 1,158. Just look at the other ones. So 1,200 for 1321 Lofts, 1168. That's a little more comparable for Palms on Main. Next. And most of these are not even in like smack downtown, or they may be downtown, but they may be a little farther away. And just look at the pictures of this buildings yourself. You can see how much different land bank looks to them. The Vista Lofts is even 1634 average rent, and same thing with 700 Woodrow, 1643. Yeah. Market analysis. Columbia is super close to Charlotte, to Atlanta, and to Charleston. And do you know what's happening in all those three cities? Incredible growth. Matter of fact, Atlanta is one of our target markets too, but it's so competitive, it's hard to get any decent deal there because all the institutional investors and all the smart money is going to Atlanta and buying all those things up at a premium. Same thing with Charlotte. That's another place that is blowing up absolutely right now, and we're actively looking for deals there too. Charleston is also close by, and that's in South Carolina, and it's another place that is growing very fast and has a very thriving multifamily market. Next. Columbia also has incredible in-highway connectivity. So you can see how connected it is to all this different, at least 3 different interstates. And that makes it a very attractive place for e-commerce companies, for any company that wants to distribute their goods all around the Southeast. It really is uniquely located in that regard. Next. And for these reasons, Columbia has gotten a lot of awards, and has gotten awards for being a great place for millennials, for being a great place to retire, and for being a great place for business. I mean, it's in that regard, it's just a good place for everybody from the young to the old, and certainly for business owners. Next. The population is 843. Population growth was 8.6% over the last decade. Year over year rent growth has been 10%. Next. But the UN just did a study that ranked Columbia 7th overall in projected population growth among US cities of 500,000 population or more. And this is where we got the metric of the expected growth of at least 43% increase by 2030. So we do expect this to be a place that continues to grow fast. And it makes sense if they are doing a $1.3 billion development just 7 blocks away. And this is the capital city of South Carolina. Some of the metros in South Carolina, like Charleston, like Greenville, kind of overtook Columbia, but Columbia is slowly but surely catching up now. So it's close to a lot of business, entertainment district. It's close to a lot of hospitals, malls, the University of South Carolina School of Law, hotels, and steakhouses. And this is just an illustration of how close it is to all of these things. Next. Yeah, next. This is just another fancy place that people would love to go to that's close by. And that's that $1.3 billion development that's just blocks away. It's a baseball stadium there, some mixed use development there also. Next. The University of South Carolina, by the way, has a major economic impact on that Columbia MSA. It supports about 1 out of every 9 jobs there. So I mean, it's massive. And one of the things we didn't even include in this presentation is the fact that the Army training base that almost everybody goes for basic training. It's also in South Carolina. So it's a vibrant place in a lot of ways. Insurance technology companies are there next. And I'll pass it on to my dear co-founder, Leslie Awesome. Let him talk about the financial overview.
Thank you so much, CEO and Chairman, Dr. Giuliano Zoni, for an amazing start to the presentation. Like Dr. Oni mentioned, we buying this property at a 5 cap, which is unheard of in this market. Occupancy is at 99%. Again, average annual return is 19 to 25, projected conservatively with a 2.3 to 2.7x equity multiple. Again, projected conservatively. Next slide, please. Again, for the debt on this deal, which is something we're really excited about, especially given the current economic climate, we are assuming a debt, and we're assuming that debt at 4.34%. So going into this deal, we know what our interest rate is going to be over the next 7 years because the debt is fixed. It's a long-term debt. So with everything that's happening right now in the market, most debts that you get are around 3%, which is significantly lower than what we have right now. But we know the Fed has already announced that they're going to be increasing interest rates maybe 3 times next year. Nobody knows how high those interest rates are going to go. So for us, having this property with a fixed interest rate, we already know what our payments are going to be over the whole period. And we're only going to have about 6 months of interest-only payments left. So from year one, we're going to start paying down the principal on this property, which means we're not just building equity on the rent growth and the appreciation. We're building equity by decreasing the principal on the deal as well. Something that is very good for this particular climate. And that's one of the reasons why we're so excited about this property. And on the right, we just have a use of funds breakdown. The down payment is about $3.9 million. We have closing costs of about $393,000. Acquisition fee, which is 3% of about $500,000. Value add cost, again, $699. And we always have reserves in all of our deals, which is $261. These reserves just sit in case we run into any surprises in the property that we did not project in the deal. These reserves are there so we don't have to come to our investors and start asking for any money. So I know we also underwrite with a lot of cushion going into these deals. There are other areas where we build in reserves based on the cushion on operations, where if we run into any issues, we know that the deal is strong enough to take care of it. So this one is very solid, very well conservatively underwritten, and we're very excited to be presenting it to you guys today. Next. This is just a highlight on the underwriting. Unfortunately, given the numerous numbers that we have on every underwriting template, it's hard to put everything on here. But I just want you guys to pay attention to a couple numbers here. The average effective rent going into this property is $1,100. And we are projecting that on exit at year 7, our effective rent is going to be at $1,400 and the market rent is at $1,538. As you saw on the rent comps, there are properties that right now in downtown Columbia that are already renting on an average rent of about $1,600. Given some of these properties are slightly bigger than ours, but size is not that much significant when you're looking at a downtown location. Most renters in this kind of locations rent because of the location, and land bank is primarily positioned to do very well. That's why it's been 99% occupied since I think about July of this year. And one other thing that I want you guys to pay attention to is the line highlighted in yellow. We are buying this property with historic tax credits, which means our taxes are fixed throughout our whole period and beyond. So because this building was a historic building, as Dr. Oni mentioned, the green awning that you see in the building is a moneymaker because it's keeping our taxes fixed and allowing us to increase cash flow over the years. Just to give you an example, our property 12 minutes away from this that we purchased in April for $12.55 million, our taxes on that property is going to be $237,000 next year. No, sorry, this year, 2022. But in this property that we're paying $17 million for, our taxes are fixed at $70,000. Taxes is one thing that really eats up on cash flows when we underwrite this property. So having this tax advantage in this property is very desirable. And it's throughout our whole period, which could also be an enticing piece to use to sell if we do sell the property year 7 to sell to the next owner, because they'll be able to inherit those credits as well. And the other thing that is not probably showing on here that I wanted to show you is like the rent growth that we're projecting. Last year, the rent growth in Colombia was 10.23%. We are projecting our rent growth at 4% this year and 3% moving on from then on. That is despite the rent growth that is being projected. If you look at CoStar, Colombia is projected to have about 8-point-something% this year and about 6 to 7% next year. But we like to stay conservative and allow that cushion in case we run into any issues with our business plan so that covers us. This is the same strategy that we use at the View, and is doing great things for us right now because we are outpacing whatever rent growth that we projected significantly on that property as well. So we're very, very familiar with this market. We know the potential of this market, and we are really, really grateful and excited that we have a property in downtown Colombia, a market which we spend a lot of time studying and working on since we started this business. Next slide, please. This is just the bottom part of that sheet that shows the distributions and the cash flow. As you can see, year 1 to year 3, there's a little bit of a deficit on the cash flow, like the preferred rate of return that gets distributed over to investors. Typically, when there is a deficit, that deficit carries over to the next year until it is caught up. Until throughout the business plan, you gotta make sure that you get your 7% pref. If we're unable to meet it year 1 or year 2, the extra cash flow from the year before gets transferred over to the passive investors. And as you can see, as operators, we don't receive any cash flow on this property year 1, year 2, year 3. We don't get any cash flow until our investors get cash flow. Now, this is underwritten conservatively because there's still income from 5G towers that are from the broker. I think it got finalized about a month before we took this deal under contract to rent the roof space for 5G towers for about $3,000 a month. That income is not included in this underwriting because that was one of the things that we did not have at that point in time, and we don't speculate in any underwriting that we do. So if that income gets added to this underwriting, it covers that deficit. So, but we did our underwriting with the assumption that we do not have that income. We went with what we saw at the property when we did our due diligence. So that's why you see that deficit there, and that gets covered even without any 5G income. It still gets covered by year 4, and it keeps doing better after that. Next slide, please. This is a sensitivity analysis that shows the cap rate variation on how that affects the exit. I did see somebody ask a question about our exit cap rate in the chat, so I'm just going to go ahead and answer that. We are projecting our exit cap rate of 5.7. That is accounting for 10 basis point increase in cap rate every year over the 7-year hold period. So we are saying that with a 5.7 exit in cap rate, this is the returns you're going to get. That's 2.3x multiple, 19.1 average annual returns, and 15.1 IRR. This is based on the current numbers on the property right now. Now, Columbia, South Carolina, a typical Class A property in Columbia, South Carolina sells for 4 cap or below. Like, we've had deals where we competed on where the cap rate was like 3.8% on a Class A deal. But given this property, we're able to get this property at a much desirable cap rate than what the market is giving. One of the reasons is because the interest rate is higher, obviously. And the other reason is because we got this off market. Like, we've been working on this deal since August. Tenny has done an amazing job in building relationships and following up. And before we were able to get this one, is one that we've worked really hard on. Now, assuming if we were using the current market cap rate to underwrite this property, on exit, we would have been projecting 2.9x multiple and 27% average annual return, but we like to be extra conservative. So we're using the actual cap rate of the property and exiting out from that. So, but the market right now is already below where we are right now. So if the market expands, if the cap rate expands in the market, it might meet us where we are right now, or it might surpass us, or it might stay lower. So there's room to really grow. That's why we're projecting that range of 19 to 25% average annual return, because there's a great chance that we could meet those projections as well. Now, based on the projection of 19.1% average annual returns and a 7% pref, Year one, $100,000 investment, and I did illustrate that that to you guys based on the pref deficit. You're going to be getting about $6,800. Year two, which is the first year of us paying full principal payments. Year one, we have about 6 months of interest only. Year two is full principal payments. You're going to get about $6,600. And then year three, we catch up on that, on all the missing numbers with the extra cash flow, and you get $5,700. And by year four, the catch up is full. You're not owed anything on the pref returns anymore, and then that pref rate keeps going up. So over that period of time, you're going to be getting this cash flows year over year. And this is conservatively projected. There's a great chance that we probably going to outpace this significantly. And when we sell the building, based on your ownership share with $100,000 investment, you're going to end up with about $80,000 from the sale. And added to that, plus your initial $100,000 investment, you receive $234,000 total throughout the whole of the deal, which translates to 2.3x equity multiple. And again, just had to put this on here, a special slide. Taxes are fixed until 2034. Really amazing, gives us a lot of room to increase our cash flow. And at this stage, I'm going to pass it over to our co-founder, Director of Acquisitions, Mr. Tenny Tolofari.
Leslie, man, I don't know how I'm going to meet up with you and Julius, but great job, guys. I appreciate the presentation so far. I'm just going to talk about the management team and the sponsor of this deal. Again, you might have a great product, a great deal. Without a great management team, everything is just going to go and go the wrong way. So we're excited to be the ones leading this acquisition. On behalf of myself, who is the Director of Acquisition, Leslie Awas, who is the Director of Operations, Braden Hyde, who is our Executive Assistant. We're humbled to be led by Dr. Julius Oni. He has been tremendous in leading us and moving this company from where we started to taking us to the next level. And we're super proud to present this opportunity to all of you today. Next slide, please. Also, in deals of this size and bigger, you definitely need partnership. And we at XSITE Capital, we pride ourselves with creating genuine, last-long relationship. The two individuals you see on the screen here, Chris Lento, he is somebody we've known for over 2 years. He has over 18 years of experience in multifamily, and he has over 160 unit property that he's managing across different cities and states. So we are proud to have him as part of the management team for this property. And then Brad, who is a developer in Boston, has about $132 million of transaction in the last 5 years. These are guys that are going to be working with us as key principal and managers of the property. Chris Lento currently is an active manager of our property that we have in Colombia as well. And then very importantly, First Community, I cannot speak enough about them. They are responsible for this deal. I can remember vividly when this deal was presented to us. If not that they were available to step into the property, took a look at it, and gave us the confidence that this is a gem, we would have actually ran from it, because if you look at it from the outside, you think it's a 1930s deal. But they looked at it, looked at the bones, and looked at the year it was reconstructed to apartments in 2016. They were like, "Hey, this is an amazing property." Actually, there's something that they did outstanding on our last property. One of the manager with First Community actually received an award recently as the I think they call them the Beautification Award, because of the outstanding work that it did in our apartments that we have in our previous apartment we bought in April. So she received an award for the work that she's done. Dr. Julius Oli had mentioned earlier about our beautification, the things that we're going to do on this property. We're really, really proud to have First Community chatting at that for. As you can see right now on the screen, they have managed over 200,000 units across the country. So we're really, really proud to have an experienced property management company leading the chart for us. Next slide, please. And our portfolio, humbly, we're proud to announce that as of right now, XSITE Capital has about $107 million of management, starting with our first property that we got in 2020, the Griffin at Petworth, a Class A 49 unit deal, a $19.1 million deal. A lot of you here today I think some of you here was part of that project. And then we got the View at St. Andrews, which is the one we have in Colombia as well, $12.55 million deal, 132 unit. And then in September, we closed on Elevate on Main, which is a 400 units, $96 million deal with our partner at Viking. So we're humbly proud to announce that we have this deal that we have under management. And when we close on this deal, we're going to be at $125 million of asset under management. So we're super excited about that. I'm going to pass it on now to Julius to wrap it up. Again, thank you for the presentation.
Yeah, thank you, everybody. Thanks so much for that, Tanny. I really appreciate you all for sticking through that presentation. I think it's time for questions and answers, which is usually my favorite part of this webinars, because we get to really get to the bones and the meats and the bones of this. So are there any questions that people have? I think some of the questions Leslie has been trying to answer in the chats. Let's see if there are any questions. I think, Jason, your questions about the reversion cap rate, which is the exit cap rate, I'm hoping we did answer that. Right, Leslie?
Yes, that's correct. That's correct. We answered that.
Yeah, and the pref return options, you did explain that, correct?
Correct, yes.
Awesome, good. Let's see if there are any questions we hear.
So there's
somebody asked, are there concerns about First Community's poor online ratings?
Interesting. Well, we can only tell you. So this is it. First Community is a very large company. They manage over 200,000 units all throughout the U.S. And they experience, there are different people that manage the different parts, and it may be a different First Communities. I'm not sure.
So Ron, if you're referring to the management company on the property right now, it's not First Communities. But if you're talking about First Communities from another property, our experience with First Communities has been amazing.
It's been unbelievable.
Yes,
amazing. Particularly the regional directors that we work with in South Carolina. They are unbelievable. Just like Tanny said earlier, they got an award for a beautification award for building over 26 years on our last property. I mean, Braden, if you could just find that video of the renovations.
I have it. I think I have it up here. You mean the picture, right?
No. The video of the renovations they did in our clubhouse at the View.
Oh, okay.
Yeah, if you could just play that, you don't have to put any sounds on it. Just play it in the background so that people could check it out. But that's a great question, Ron. Thank you, Dr. Baker. Really appreciate that. But yeah, I think if the poor online ratings are what you're reading right now, First Communities is not always managing the property currently. They are going to be the people managing their property once we close on it. Can you mute that? Can you mute it? Just kind of show it. Yep, excellent. And Grant Caruthas was asking, is the co-working space established and you improving or an all new offering? Leslie, I'll let you take that.
It's a whole new offering, Grant. Like Dr. Julius only mentioned, there's a lot of unused space in the building. I saw you also asked about the storage space square foot. I'm going to answer that too in this same question as well. So there's a lot of unused space for storage on each of the floors. There are about 3 closets that were being used as equipment spaces, which we're going to move to the basement of the building. There's a lot of unused space down there as well. then we're going to use those little closets as storage spaces and rent it out to the tenant. So it's about 3 per floor, which comes out to about 15 of those units. Then there's a bunch of unused space, which we're not sure yet how much storage space can be built there, but there's room to build a co-working space and there's room to build storage spaces. So we're going to do a little bit of both. Start off with a small co-working space and test it out and see how the tenants respond to it and see how much income we're getting from it. The storage, we know for sure it's an income generator because the tenants have already been asking for it.
Yeah. So what are the parameters for investment, minimum investment by Dr. Amukele? $50,000 is the minimum investment. Maximum investment of 500K. We promise you we wouldn't take 500,000 anything more than $500,000 from you. So don't give us more than $500,000. Yeah, but otherwise we should have the subscription documents, the operating agreement, the private placement memorandum, all set and ready to go, hopefully before the end of the week. And people will be able to start reviewing that on our private investor portal, Syndication Pro. And once you review that, then we can start taking having people wire the money in and get this show on the road. We expect that the funding is going to go through January 28th, and we just got word today that the loan assumption is going to close, meaning we're going to take over the property probably around mid-February sometime. Yeah. So, yeah. So, Jason Brooks, I heard about the equity multiple, but I didn't hear the actual reversion cap rate that's been assumed. If we are starting at 5%, what are we assuming that we're exiting at? Jason, actually, it was on that sensitivity analysis screen where Leslie was showing that our assumption, it's actually based on a 5.7% cap rate at exit, which is 70 basis point over what we currently buying it at currently. But the thing to note is that the market cap rate for a Class A property right now is actually 4% or less in some cases. So, but we still did not make that assumption. We made the assumption that we started from the cap rate that we bought the property at, which is 5, and we projecting that we'll exit at about 5.7%. Does that answer your question, Jason? I hope it does. If not, just ask the question again, and we'll give it another shot. Your estimated cash flow is around 7% of the investment amount. Is there a conservative floor to this? The conservative floor to it is what we displayed in those first 2 to 3 years when we are actually evaluating on the property. So meaning it's 6,000. What was it that Leslie just showed? Like less than more than $6,500. Is what we think the conservative floor is. But obviously, this is an investment. Who knows what happens in the market or what happens in the property? If there's any reason that we are not able to give you your 7% pref, be rest assured that we're going to catch you up on it as the property stabilizes. We do not expect that to happen based on the conservative underwriting that we've done on this property. We are extremely confident that we're going to be able to give you your 7% pref. If not in the first year, certainly catch you up by the second or third year and moving forward. If you owed past 7 years, how will the expiring tax freeze affect exit, grant tax that? The tax freeze, that's $70,000 in taxes, is fixed until 2034. Fixed, not moving. So it's not going to affect. And 2034 is what? It's at least 13 years from now, 12 years from now. So we have at least 12 years, and we have an opportunity to actually reapply to maintain the tax credits. if we just maintain some of the historical things in the building, that's why we're never going to take off that ugly green entrance, because it's part of, we're never going to take off the logos of the banks either on the building or in front of the building. So those are the things that help us maintain the tax credit. Since this is an older building, has there been an inspection and did it yield any repairs? Great question, Edwin. Yes, we did a fantastic due diligence, went through all of it. And let me remind you, Edwin, that this is actually not an older building. It's an older shell, but a completely new building on the inside of it, if that makes any sense. The plumbing, the electric, all of that is all new. So this is a Class A property. It's a new property, actually. Was literally built in 2016 inside this bank shell, that if you want to think about it that way. Edwin also asked, what's the percent occupancy to break even? That's about 78%. So about 74 to 78%. That means we could literally drop the occupancy of this property to 80%, and we'll still be able to pay our mortgage, and we'll still be able to pay some returns, but it may just be a little tougher at that point. This has not happened in that market since we've known the market, but we don't expect that to happen given the fact that there's even if there was an economic downturn, people still need a place to live, right? So people still need a roof over their heads. Yes, we may not be able to escalate the rent or increase the rent the way we anticipate, but certainly people are still going to need a place to live. This is still going to be a cash flowing property. There are not that many new developments when it comes to multifamily happening in the area. That's why all the properties have 98 to 100% occupancy rate. So that's what you can expect with this particular property, that we are very, very confident that this property is going to maintain excellent occupancy. We are the ones trying to get it down to about 95% occupancy, so that we shows that we are at the appropriate market rates with regards to rent. Grant Caruthers, what situations would drive you to Old Pass? What situations would drive you to Old Pass 7? That's a great question. Leslie, I'll let you answer that.
Yeah, so the refinance, so we love Columbia, South Carolina, and we feel like Columbia, South Carolina is still in the very early phases of its growth. Now, if we get into the property and we start seeing this growth picking up despite everything that's going on, we might actually be able to refinance this property early on and return back 100% of the capital and hold on for a longer period of time so that our investors continue to receive infinite cash flow. So it's going to depend on what the market conditions are at that point in time, right? If the market favors us to exit and return the returns that we're projecting or more, we're going to do that. But again, like we've been mentioning, we've done a lot of these projections based conservatively. So at that point, when we get to year 6, year 7, we look at the market. If Columbia, South Carolina is booming, like what we're seeing in all the other South Carolina markets, it might make sense for us to refi and hold on for a longer period of time and continue to get cash flow. And the beautiful thing about refinancing is the money that you get from refi is tax-free. So we can hold on to the property, take advantage of the growth, and keep refinancing and keep returning capital back to our investors and continue to take advantage of the cash flow for infinite returns. So that will be some of the things that we look at when we get to that point. But again, our number one priority is always preserving in investor capital. Second priority is growing it to at least where we're projecting. And then thirdly, we want to help our investors grow wealth. So this might be one of those ideal properties that will be like a wealth builder that we could hold long-term and continue to generate passive income from. So those are all the things we take into consideration. I hope that answers your question, Grant.
Mailbox money, or maybe direct deposit money. Anyways, what's the percent? Actually, Edwin already asked that question. Yeah, I think maybe
the active occupancy rate was stable since 2016. I
I
believe,
don't know the answers to that
I think a
exactly.
Mulberry. I think early on in the property, of course, when you develop, you got to do like the
Stabilization
the
phase.
lease up period. But from 2018, occupancy has been stable. The lowest it has dropped to has been about, I think, like 87%. And they had to change the management team over there and get it back up. So they say it's been stable at least for the past 12 months.
Awesome. Good to see you, Dr. Barry.
And as you saw in the presentation, right now, every property in downtown South Carolina is like 98, 99% occupied. So the downtown location is highly desirable, not enough properties. And a lot of those properties on there are very old. Some of them have not been renovated, so which is not like land bank.
So Amit was asking what percentage of the property are students. Braden is typing the answer to that very shortly.
I think it's 14%.
14%.
And most of them are graduate students that go to University of South Carolina Law School. When we talked about the average income, 2 incomes were excluded, which were incomes of some of the parents of the students that were over there. Those incomes were above $600,000, and it was so out that we could not include it in the average income. So these are kids from that have enough to take care of their parents usually sign on the rent. And,
So we didn't want to skew the numbers so that it wouldn't look too look inflated at all. We wanted to just keep all the incomes that were like kind of close together, and that's what we did. That's why we eliminated those 2 outliers, the $600,000 or $500,000 or more in income. Any other questions? Those questions came in rapid fire. I love it.
Yeah, we have a question from Jason Brooks. I don't know if we've answered this already. He said, what's the reversion cap rate?
No, that's been answered. All that has been answered.
Okay.
Yep. Right, Jason? I hope it is.
All right.
Yeah. So any other questions? Actually, I think we went past by about 6 minutes and everybody is still literally here with us, going strong with us. It's so beautiful to see all your faces, at least your names, since I can't see your faces. But look forward to seeing your faces properly soon. Dr. Marshall, wow, this is a great group here. We've got our partners, Madhu, Hamid, Dr. Goya, Dr. Ramaswamy. We really appreciate you all for joining us today. And many of you have invested with us before. So I know I'm preaching to the choir when I tell you about the power and the wealth creating power of multifamily real estate. But for those of you that are new to us, we do hope that you're able to join us on this fantastic investment opportunity. We look forward to continue to educate you about multifamily real estate. And for those of you that are also interested in actively participating, like going out and taking down these properties yourself or in collaboration with us or other people, we are more than happy to also be part of that growth for you. So please engage with our content. We'll definitely take your email addresses and send you information about the things that we're doing. Let us continue to learn together, and we look forward to growing your mind and growing your wealth together. And so to my co-host today, I really say thank you to you all, and to everybody else that's joining us. We know you could be anywhere else in the world, but you're here with us. We don't take that for granted. And we really thank you. We appreciate you. Happy New Year again, and have a fantastic one. We look forward to seeing you on this deal. Thank you.
Everybody.